In accounting, the rules of debit and credit are used to record financial transactions in an organized and consistent manner. These rules are based on the accounting equation, which states that assets must always be equal to liabilities plus owner's equity. Debit and credit are used to represent the increase or decrease in the balance of an account. The following rules apply. Debit refers to the left-hand side of an account, while credit refers to the right-hand side of an account. Debit is used to record an increase in assets and expenses, and a decrease in liabilities and equity. Credit is used to record a decrease in assets and expenses, and an increase in liabilities and equity. Each transaction must have at least one debit and one credit. The total amount of debits must always be equal to the total amount of credits. The accounts that are debited and credited must be chosen based on the type of transaction being recorded. Here are some examples. When a company receives cash from a customer, the cash account is debited, increased, and the accounts receivable account is credited, decreased. When a company pays rent for office space, the rent expense account is debited, increased, and the cash account is credited, decreased. When a company borrows money from a bank, the cash account is debited, increased, and the loan payable account is credited, increased. The accounting equation is the fundamental principle of accounting that represents the relationship between a company's assets, liabilities, and equity. It is also known as the balance sheet equation because it is used to prepare a balance sheet, which shows the financial position of a company at a specific point in time. The accounting equation can be expressed as follows. Assets equals liabilities plus equity. This equation states that a company's total assets must always be equal to the sum of its liabilities and equity. In other words, the resources owned by a company must be financed by either debt, liabilities, or equity, ownership. Here is a brief explanation of the three components of the accounting equation. Assets. These are the economic resources that a company owns or controls, such as cash, accounts receivable, inventory, and property. Assets are usually listed on the left-hand side of the balance sheet. Liabilities. These are the debts or obligations that a company owes to others, such as loans, accounts payable, and taxes payable. Liabilities are usually listed on the right-hand side of the balance sheet. Equity. This is the residual interest in the assets of a company after deducting its liabilities. Equity represents the ownership interest of shareholders in the company's assets and is calculated as the difference between assets and liabilities. Equity is also listed on the right-hand side of the balance sheet. The accounting equation is a fundamental concept in accounting and is used to ensure that the financial statements of a company are accurate and reliable. It is important for business owners, investors, and creditors to understand the accounting equation in order to analyze the financial health of a company. Event in accounting and what is a transaction, elaborate cash and credit transactions. An event in accounting refers to any occurrence that has a financial impact on a business and can be measured in monetary terms. It is an economic activity that is recorded and reported in a company's financial statements. Events in accounting may include the purchase or sale of goods or services, receipt of cash or credit, payment of expenses, and so on. A transaction in accounting refers to an exchange between two parties that involves the transfer of something of value, usually money, goods or services. Transactions are recorded in a company's financial records and are used to prepare financial statements. Transactions can be classified as cash transactions or credit transactions, depending on the mode of payment. Cash transactions refer to those transactions in which cash is either received or paid at the time of the transaction. In other words, cash transactions involve the exchange of cash for goods or services. Examples of cash transactions include the sale of goods for cash, payment of wages in cash, and purchase of raw materials for cash. Credit transactions, on the other hand, refer to transactions in which payment is deferred to a later date. In a credit transaction, the buyer receives the goods or services but does not pay for them immediately. Instead, the buyer promises to pay the seller at a later date, usually with interest. Examples of credit transactions include the purchase of goods on credit, taking out a loan from a bank, and paying for goods on credit card. In summary, events in accounting are economic activities that are recorded and reported in a company's financial statements. Transactions, on the other hand, are exchanges between two parties that involve the transfer of something of value and are recorded in a company's financial records. Cash transactions involve the exchange of cash for goods or services, while credit transactions involve payment deferred to a later date. Rules for deciding cash or credit transaction. In accounting, the decision of whether to make a cash or credit transaction depends on various factors such as the nature of the transaction, the creditworthiness of the parties involved, and the availability of cash or credit. Here are some general rules for deciding between cash and credit transactions. Cash transactions are preferred when the seller needs immediate cash or when the buyer does not have a credit facility or has a poor credit rating. Credit transactions are preferred when the buyer needs time to pay and the seller is willing to extend credit. This is often the case for high-value transactions or for customers who have a good credit rating. For routine transactions, such as the sale of small-value items or the payment of minor expenses, cash transactions are generally used. For larger transactions, such as the purchase of assets or the payment of salaries, credit transactions may be used if the buyer has a good credit rating and the seller is willing to extend credit. In some cases, a combination of cash and credit transactions may be used, such as when a partial payment is made in cash and the remainder is paid on credit. Ultimately, the decision of whether to use cash or credit transactions depends on the specific circumstances of each transaction and the financial position and preferences of the parties involved.